Can my investments go to zero? We'll answer that in this video. Hey, this is episode 10 of our back to school, back to basics in investing and personal finance. I'm Hervin Pesa. I'm a financial planner, but just like you, I'm still on this journey to building wealth and financial independence. And this channel aims to provide you with the money lessons we never learned from school. To sprint towards this mission, we're publishing a video every single day in September, so be sure to subscribe and hit the bell so you never miss any of our lessons. Can my investments go to zero? This is a question that we commonly get. And in yesterday's video, we talked about risk and volatility from a bigger picture. I know that there are many other kinds of risks, and most of the questions I get about risk are about volatility and balance going down. But this is probably the second most asked question when it comes to investing for new investors. So can your investments really go down to zero? Yes, absolutely, especially if it's a single position. Just kidding, we're not done. Of course, I wasn't just gonna leave you guys with that. Now, how about if it was an adequately diversified portfolio? Can it go to zero? Think of the worst financial and economic disaster, all the bad news headlines that you could think of. Think of them right now. Did you come up with the dot-com bubble? Maybe 9/11? How about the housing crisis, the great financial crisis in 2007? Or Black Monday in 1987? Now, if I ask you to name a prominent company that just went under or just completely got crushed in the last 10 or 20 years, what comes to mind? Do you think of Toys R Us, maybe? Research in Motion? How about Sears? Now, who remembers Kodak? Last year, JCPenney went through bankruptcy proceedings, and countless other retailers. If you're a bit older, you might come up with Nortel or Enron as your example. Now, think about some of the worst political news and natural disasters that made major headlines that scared the crap out of you when it comes to investing way back then. Recently, there was the trade war between US and China. How about the Brexit, conflict in Ukraine? How about the Middle East repeatedly playing chicken against the US with oil price wars? See, there's hurricanes and earthquakes and tsunamis. There's even SARS, Zika, Ebola, and now COVID. Think of all these events, and yet the markets, investments, the capital markets has not gone to zero. In fact, it could not be further from it. So let me hop onto my screen so I can show you and probably go over some market history and crazy information that could either be overwhelming or help enlighten you. This is the 2021 index chart by Morningstar. As you can see, there's tons of information, and we'll probably use this and discuss this again in other metrics. But today, I just want to focus on a little bit of history. I just want to show you that despite all the negative news, all the stuff you hear, how the world markets are growing crazy and we're living in interesting times, we're probably living in average times. Look at the US and the Canadian markets. It's marched on up and to the right. You see, when you invest, especially when you invest for the long term, I guarantee that there will be times of choppy markets and volatility, and there will be news articles that will make you question why and how you even invested in the first place. It happens to me, it happens to my clients, it'll likely happen to you. See, when we onboard clients, we'll let them know that there will likely be times like this, and we expect them to call us freaking out because they might see a statement that they don't like in the future, or they might see a news article talking about how the market's gonna go to crap. There are two, maybe three main tools that we can use as an emergency response kit for our clients and maybe for you as well. First is the financial plan. Second is market history, and third is the why. Why we invested the way we did, and why we wanted and needed to invest in the first place so that we can meet our goals. Look back to the financial plan. So this is how we can visually walk through history. See all these black dots? That highlights a significant event that would have impacted the markets and very likely the news cycle. The chart has more black dots than before Hervin discovered facial cleanser, yet history favored investors again and again and again. We're constantly climbing over a wall of worry, yet if we persist, we tend to do well. This chart allows us to visually see how much $100 would be worth if it was invested over an extended period of time, depending on the asset class of choice or the portfolio of choice. It compares 6 different asset classes and a balanced portfolio. The first asset class is the US Small Cap Total Return Index. Number 2 is the US Large Cap Total Return Index, which is represented by the S&P 500. Number 3 is the S&P TSX Composite Index, and that's the Canadian Equity Index. It also has the 60-40 balance, which is broken down this way. 30% of it is in Canadian equity, 30% in US large stock, and 30% in long-term bonds, and the rest is in cash. It also tracked the FTSE Canada Long-Term Bond Index, the 5-year GIC, and the 91-day Treasury bills, which represents cash. Please remember, none of these figures are intended to give you any form of investment advice. I am strictly presenting data based on tools easily available to me that we can use to remember that this time is not really that different from what's happened in the past. Now let's look at this. This chart goes all the way from 1950 to June 30th of 2021. Before I get to the final amounts, I just know that one of you is thinking, why do we need to look at something so long-term when I retire in less than 30 or less than 20 years, or maybe even sooner? Why do I need to understand such a long-term view? It might not apply to me. Well, here's the reality of this, okay? You do not stop investing simply because you hit retirement or you hit the goal you have. Your behaviors and your portfolio structure will undoubtedly change over time when you go from a net saver to a net spender or drawer of your funds, but leaving the capital markets altogether and going into cash will be disastrous. So let's go back to the chart. $100 invested in the US small cap index ends up at $990,000 over this period. The average compound return is 13.7%. The large cap ends up at $303,000, $304,000 almost. Average return 11.9%. The Canadian stock index 83,000 at 9.9%. The balanced fund is at $67,171 at 9.5% annualized. The Canadian bond index is at $15,113 with an average return of 7.3% over that time horizon. The 5-year GIC is at $6,500, net return 6%. Cash comes in at $3,300 with an average return of 5%. What's surprising to me about this is CPI, which is the inflation indicator. $100 when this thing started will now cost 11 times more at $1,156. Now, did any of these figures surprise you at all? Let me know in the comment section below. Now I'm getting repetitive, but I really believe the odds of the total market going to zero purely from a lack of value and economic challenges is slim to none. The only reason I can even imagine why the total stock market of a developed country such as Canada, US, UK, Australia would go to zero would be a complete change of societal ideology. Let's do a little bit of history. The Chinese market has had roots going back to 1860s. Hong Kong going back to 1890. Yet the Shanghai Exchange and the Shenzhen Exchange and the Hong Kong Exchange did not go back into the tracked market indices until 1990. That's because in 1949, China became a communist country. The same thing happened to Russia in 1917. Just like the Chinese exchanges, they didn't get tracked until 1990. And under the communist system, there is no private enterprise. Hong Kong also had primarily state-owned enterprises at that time, so there were no stocks to exchange. Going from capitalism to communism is the only thing I personally see that can cost the US, the Canadian market to go to zero. And that's an unlikely event in my opinion, unless you believe otherwise. And that kind of event would entice wars and unrest, which would likely shift our focus from investing to survival anyway. So at that point, you'll be stocking guns and gunpowder. And think about it this way, if it does happen, we can all rest easy since Big Brother will likely take care of us, right? We don't need stocks or the markets to invest in anymore. Look how well that's done for Russia. See, I know that capitalism and having a free market is far from perfect. It's probably the worst way to run an economy, except for all the others which we've tried. And as long as there's problems that need to be solved and entrepreneurs and people willing to seek to provide solutions, there will be a capital market. One that you and I can participate and invest in. And by investing, you and I are sharing some belief in capitalism. And I think it's going strong. You know why I think that? I have a leading indicator for it. It's ideas. Ideas that can be protected and executed on for service and for profit. So how does it get protected? Intellectual property rights, they're all protected by patents and trademarks. In 2017, a paper was published by the Hamilton Project. It was written by Jay Shambaugh, Ryan Nunn, and Rebecca Portman. They presented 11 interesting facts about innovation. And my favorite fact is when they wrote it, way back in 2017, the US Patent Office had 6 times more patent applications compared to in 1980. So in 2020, I looked it up. In the midst of the global shutdown, there were still 646,244 patent applications. That's 650,000 ideas that need protection for innovation and likely for business use. So no, I don't think the market will go to zero. Not unless you and I magically get everything for free and somehow we all simultaneously just quit owning things. We stop clothing ourselves, we stop eating out, we stop doing things altogether, and we stop trying to cure diseases and stop looking for medicine. See, even AOC, a beacon of socialism, as much as she wants to give everything away for free, she makes a profit from merch sales and speaking fees and so many other things. And you can apply this to any political icon and where the spotlight goes. Majority of most of these recognized names will have some sort of equity position and own a sliver of a private enterprise. So let's continue with this thought experiment. Now, what if it does happen to one of the countries you have exposure to? What if it gets expropriated and the whole market just goes to zero? Remember I mentioned Russia and China earlier? The Credit Suisse Global Historical Yearbook shows returns since the 1900s. This historical run includes the expropriation in Russian assets and Chinese assets in 1917 for Russia and 1949 for China. Yet the global real return in this period, as represented by the World Index, is 5.2%, which means whatever inflation was, equities beat it by 5.2%. Bonds didn't do as well, but they got a 2% real return. This shows the importance of a geographically diverse portfolio, or at least a reason to have more of a global outlook instead of just falling prey to a home country bias. So again, I'm gonna repeat myself. Chances of it going to zero, fairly slim. The other situation where I would see this happening is a zombie apocalypse, but that's a bit of a stretch. So what are the key takeaways from this? Look at this 71-year stretch of time. There's about a dozen recessions with US and Canada. The market and the index tracking them has not gone to zero. We've had a few trade wars and currency dumps, yet the markets have not gone to zero. Canada has had conservatives and liberals in power, yet the market has not gone to zero. So, can diversified investments go to zero? I mean, there's always a chance, but history shows you're more likely to grow your assets than have it to go bust. I know that the chart has a lot of data and we'll probably use it again, but I had to focus on this single answer for this video. So historically speaking, answer to that question, probably not. So if all these past events have not brought bonds or stocks or cash to zero, what will? Hey, I know I threw a lot of data and some investment history at you, but remember, I don't know you. I don't know your personal circumstances, so please don't look at this as any form of investment advice. I simply want to defend my opinion on why the chances of a properly diversified investment portfolio will not go to zero. And in tomorrow's video, we'll talk about diversification. We skirted around it a lot of times in this conversation, but let's hammer it further in tomorrow's conversation. Until then, stay aware, take control. I love y'all. Bye. Watch the playlist here. Check out yesterday's video over here. Be sure to subscribe.